Welcome back to Financial Analysis for Nonprofits. And so here we are, week 7. We made it through the course. It went quickly, didn't it? I can't believe here we are at week 7. So today I really want to talk about, I think one of the things that you see in nonprofit finance, and a lot of people want to use ratios. And there are some really good ratios that I think are effective. And then there are some ratios that aren't really going to give you the data that you think they're going to give you. One of the big problems, as we've kind of mentioned previously, is that I think a lot of this is coming out of the for-profit world. And for for-profit corporations, it makes sense. But when you're trying to apply them to nonprofits with restrictions and temporary net assets being released or different types of liabilities, it doesn't always equate to what you're going to get in the for-profit world. So I want to share just some common ratios. Overall, I'm not a generally big fan of ratio analysis. I think it oversimplifies what can be sometimes very complex business models. But the reality is people use them. Donors use them. Websites use them. These charity watchdog type organizations. So you need to understand what are some of the ratios out there, what they're supposed to be doing, what are some of the limitations. And that's all I really want to hit today. I know you all are working on your final project, your financial analysis of one of the nonprofits. And so, again, you might be, some of these might be things that you want to use, but again, I think we just need to be aware of some of the limitations of them. So a couple of the ratios that we've been using, whether you know them or not, or whether you've recognized them as ratios. One of it is really the unrestricted operating performance. And this is what you're tracking in their final project, right? And what are we talking about here? Well, we're talking about the difference between the total column on that audit and that unrestricted column. So here, what we're trying to really do is find the total unrestricted revenue minus our total operating expenses, right? And that's really going to give us the unrestricted. That's how much money did we really had available to cover our operating expenses, our salaries, and our light bills. Typically, you're going to want to aim for something at least at 3%. Anything under 3%, plus or minus 3% is, I typically consider that break even. If you have a 1% deficit or 1% surplus, that's really break even performance. If you're starting to get over 3% in either terms of a surplus or deficit, then that's a little bit more significant and you should be paying attention to that. But we've talked about this. This was week 2 when we looked at the income statements, the statement of activities. This was, remember, I said, focus on the unrestricted column. And that's really, I think, the number one question, because the first question is, are we bringing enough revenue to cover operating expenses? And we're really talking about unrestricted revenue. And that's what this calculation is. All right, second one, same thing. We've already talked about it, months of cash, right? We take the total amount of cash and investments the organization has, and we divide that by their average monthly expenses. Now, again, the biggest caution here is not all cash is usable, right? Some of it is restricted. Some of it may be in the cookie jar that we've talked about. Some may be in the safe, right? Some of it may have liabilities. There may be bills that are due tomorrow, debt, loans, mortgage payments, rental payments, payroll, salary. So some of that cash, even though you have it, is already earmarked, is already allocated to something, or it's restricted. So again, months of cash is probably the most common liquidity measurement you're going to see out there, but we always need to remember if there's restrictions involved, this is not always the most accurate. So that's why we spent a lot of time focusing on this Luna calculation. And again, as part of what you're supposed to do for the final project is calculate both months of cash and Luna and kind of see the difference. Now, what are we doing here with our Luna calculation? Again, we're not looking at our assets. We're not looking at our cash and investments. They're assets. We're not looking at our liabilities. We're looking at our net worth, our net assets. So that already accounts for all of our liabilities. So we've already backed out any money that we owe people. And because we're looking at the unrestricted net assets, we've already taken into account restrictions. So the money or the assets that are in our unrestricted net assets are free and clear of restrictions and free and clear of any liabilities. The big thing is we need to remember to back out our buildings, our tables and chairs, our computers and vans, because yes, they're part of our net worth, but you're not going to be making payroll with tables and chairs. Right? At least I know I don't like getting paid in tables and chairs, and I doubt your employees would either, right? So this formula here really is backing out the property and equipment. And we need to remember that if there's debt associated with that property, right? If the building's worth $1 million, we sell it, and we have $300,000 we need to pay to the mortgage company. Remember, we're only going to net $700,000. And so the value of an asset on our balance sheet, again, is the cash value. So the accountants say, well, you have $1 million asset, 300,000 of it goes to the bank. That means your portion of that asset is only 700,000. And we did that calculation back in week 3, I believe. Yes, week 3. So long ago, and yet it seemed like yesterday. So unrestricted operating performance, months of cash, months of Luna. They're the 3 that we really kind of focused on in this course. And I still think I'm gonna say they're really, if you can get those will give you a lot of great information about how the organization is doing. Now, in terms of liquidity, we've talked a lot about this goal of 3 to 6 months. Why? Well, if we're less than 0, meaning we're in negative liquidity, right? We're borrowing from our restricted assets. We're borrowing from vendors, right? We're asking staff to delay cashing paychecks. Executive directors maybe not even drawing a salary. And that's just not a situation that's going to be sustainable for a very long period of time, right? That's not a space where you can be adaptive and flexible and innovative. It's not a space where you can take risk and try new things, right? You're in a crisis situation. Now, if you have less than 1 month, well, again, you're scrambling for cash. You may be just barely making payroll and all of that. But this is not, again, a situation where you want to. What happens here is when the cash is really tight or your needs limited, your executive director, your treasurer, your CFO are spending all their time running cash flow forecasts, trying to figure out if they're going to make payroll. And that's really not the best use of their time and effort. They need to be focused on mission, fundraising, expanding programs and services. When you get out to that 3 to 6 months, you really have that room to breathe. And if something happens, you have a little bit of time to be able to react to that. And if you got more than 6 months, then that's when really you should start thinking about how do we create reserves? Maybe we create these rainy day funds, contingency fund, program reserves, maybe put money aside in some kind of board designated endowment. Again, lots of different options. But this, when you think about liquidity, again, our goal is to try and get into that 3 to 6 months. But if you're a little bit below that, that's, not too bad. But as you start to get down closer to 1 month or less, you're starting to get in that crisis situation. Now, a couple other ratios that you'll see, and this is particularly from funders, from foundations, you'll see this a lot, and they call it concentration risk. Is the organization kind of overly dependent on a particular revenue stream? So there's 2 ways to think about this. One is something like, is the organization 95% government funded? Even though they may have a bunch of different government contracts and different agencies, but 95% of the funding is coming from government. Is that considered a risk? Some groups may think so, because then all of a sudden, if the government, something happens, the money stops flowing, the organization doesn't have a very diversified revenue stream, and all of a sudden they can be finding themselves in a difficult situation very quickly. The other way that people think about it is our dollars, the dollars that our foundation is funding, if it's the California Community Foundation, are we 90% of their funding? And is that too high? So you look at whatever the particular revenue source is, whether it's an individual foundation's funding or, say government or individual donors, and you divide that by the total unrestricted revenue. Again, we're looking at unrestricted revenue. And that'll tell you, now some groups may say, we don't want to be more than 30% of your total budget, or we don't want to be more than 10% of your total budget, whatever that happens to be. So some foundations that it really varies case by case by case. There's no kind of universal standard about if a group is too heavily concentrated in a particular area. Here, I think the big thing is, again, a lot of times we may be, oh, we're 90% foundation funded, but we have 22 different foundation funders. So if one drops out, is that going to be a big risk? Probably not, right? Somebody else will step in. And the same thing with individuals. I know All Stars, we're 90 something percent individual donors, but we have hundreds of individual donors. So if one doesn't, give in a particular year, that's not going to sink us. So yeah, we're very concentrated in one revenue stream, but within that stream, we're very diversified. Now, if we were 90% individual donors and that came from 5 people, well, if one of them drops out, then we're in big problems, right? So it's a little bit more nuanced than, again, just thinking, oh, X percentage comes from this particular source. It really is. Do we think that the key here is we're looking for reliable, recurring revenue? And are we at risk that if one funder drops out, all of a sudden that's going to blow a hole in our budget? And that's really what this kind of concentration risk is getting at. All right. I think some of those are probably the most common ones you'll see out there, and they're pretty good. I think those are really giving us information that's actually useful and helpful for us as leaders to make better decisions. Some other ratios, and we've talked about some of these already. Again, change in net assets, right? Which is really our total revenue minus our total expenses. Remember, now we started by talking about the unrestricted operating performance, which is unrestricted revenue minus expenses. This is the total column. This is the front page of the 990. This is the total column on the audit. And again, it shows the total amount that, of new money that has come in against our expenses, and did our total assets, restricted and unrestricted and otherwise, did our total assets increase or did our total assets shrink? Now, again, if you're a simple organization, you get mostly unrestricted funding. This is it's going to be pretty much the same as your unrestricted operating performance. But if you get a lot of restricted funding, a lot of net assets being released, a lot of permanent that money going into your endowment, money that might be flowing through for capital campaigns or other special projects, sometimes this can actually, again, as we've seen, that total column is not always the column we want to be paying attention to. We really want to focus on that unrestricted column. But again, this is something you're going to see very common out there in the space. Now, this is something where I think, I think a lot of people talk about current ratio. At the gist, there's sometimes people, you'll hear the quick ratio, current ratio, these different things. And what are they really about? Basically, do you have enough assets to cover your liabilities, right? Do you have enough assets to cover your backside? So, and what we're talking about is if do you have enough cash or other assets that if you liquidated your assets, could you pay all of your debt and liabilities? Now, again, typically we're going to want to have this idea of 1 point, which means if we have enough assets to cover all of our liabilities. As it gets higher, a higher number is better, right? So if we have a ratio of 2, means we have twice as much assets as liabilities. If we have a ratio of 10, that means we have 10 times more assets than we have liabilities. And so if it's below 1, that means we owe more than we own, right? And so that could be, a very difficult situation. If you're heavily in debt, you borrowed a lot of money to kind of fund your operations, and you actually owe more than you own. You're kind of underwater. That can be a very difficult situation for an organization. It puts a huge strain on liquidity. But a couple things just to be aware of, right? There are some things that we classify as liabilities that aren't things that are going to be paid right away. One of them is payables to our employees and vendors. So when an employee leaves, right, you have to pay out all their accrued vacation and benefits and all of that good stuff. Well, all of that sits on your liabilities on your balance sheet. But the chance of all your employees leaving at the exact same time and having to pay out everybody's benefits, that's probably not realistic, right? So yes, you may have an employee leave, but you're not going to have all of them. So the chances of you having to pay all of those liabilities in any one period of time is probably not realistic. So, it's not something that's really typically going to happen pretty quick. The other thing is you have something sometimes called deferred revenue or unearned revenue. This is money, mostly think of theaters or something like where you're buying a subscription to a series of plays, right? So technically what happens is I give the money up front, right? But the nonprofit has to keep that money in reserves as a liability, because if they cancel the show, they need to pay me back. So it shows up on our asset, on our balance sheet as a liability, right? Even though they've gotten the cash in, they're having to keep it as deferred revenue or unearned revenue, in the sense that if that show, until we put on that show, we can't recognize this revenue. It's not restricted. It's not restricted. But the thing is, if we cancel that show, we have to pay the money back. And so again, it shows up as a liability for a lot of nonprofits, but the reality is, again, the vast majority of nonprofits are not canceling shows. They're not things. They're not having to refund those dollars. So again, it shows up as a liability, as a debt that we need to pay or that we need to earn, but it's really not something that most nonprofits are actually ever going to really have to pay back. So things like, again, payables to our employees and benefits, deferred revenue or refundable advances. Yes, technically from the accounting perspective, they are liabilities. From the reality of most nonprofits in our day-to-day lives, that's money that's not really going to need to be paid back. So, all right. Quick ratio, again, a common measure. This it's more conservative, is that it really is looking just at the short-term cash, right? Because when you're looking at the current ratio, you're looking at all of our current assets. That includes buildings and tables and chairs and things like that. This is really just looking at cash. How much cash, kind of those short-term investments in securities that you could turn into cash very quickly, and those accounts receivable, money that's coming in the next couple of months, right? And then you divide that by your current liabilities. So do we have enough current cash and investments to cover all of our current debt and liabilities? And again, we're looking at a minimum of at least having enough assets to cover liabilities, a ratio of 1, but higher is better. So if you have a ratio of 5, that means you have 5 times the amount of current assets than you do of current liabilities. And that's great. And again, if you're under 1, that means you owe more than you own. And so again, good ratios, but not, it's a way to make sure that you're not kind of too leveraged. That means we haven't borrowed too much in relationship to how much cash and assets we have. Again, it's a good measure, but you always need to make sure you understand the context of what those liabilities are and about whether there's something that really needs to be paid back. Because we saw in the case of Homeboy too, there were some of these mortgages and stuff that actually are forgivable, that as long as they continue to operate as a nonprofit, that money is kind of written off, and it's kind of forgiven every year. So again, just some additional context. Again, a debt ratio, similar idea, total liabilities divided by total assets, or total liabilities divided by total unrestricted assets. These are all measures to see, are we able to pay our debt back? So the current ratio, the quick ratio, the debt ratio. But again, most nonprofits are not in a situation where they really typically have a lot of debt. This is, again, something that's more common in the for-profit world. Accumulated depreciation. This is important for big facility intensive organizations. And really what you're trying to figure out is how much wear and tear is on all of our buildings and facilities. And are they aging? And are we deferring maintenance on this? So if we see something where 70% of our buildings are depreciated, that usually is a warning that we're going to either need to start making some investments in our fixed and our buildings and our tables and chairs and computers and vans, or it may be time to start thinking about a replacement, right? Okay, those vans are probably got another year on them, and then we're going to have to replace the vans. Those computers are probably going to need to be replaced. That roof is going to need to be replaced. So it's a good indication of, and if you're seeing an organization that has low liquidity and they're 70% depreciated, you can start to see, well, maybe this group's going to be in trouble because they don't really have the cash and available assets to make those investments in their facilities. And what happens when the roof goes? What happens when the heating and air system craps out, right? What happens when those vans stop working? How, do they have the resources to really be able to kind of continue to maintain those physical and fixed assets that are necessary to deliver programs? All right. That's some good ones. Those are the ones I think that are probably the most common and I think the most useful. Again, they often require some additional context in order to understand, but I think there's some good ones that you can use to help you get good data. These are some ones I'm saying, these are not, these are not ones that I think are very useful, but again, you're going to see them used out in the field. This administrative cost ratio, or sometimes called fundraising to program ratios, or indirect cost or overhead rates. Basically, how much are we spending on fundraising and administrative as a percentage of our total expenses? Now, in general, again, there is no legal limit from the IRS or any government agencies that says you have to spend any certain percentage on programs. The IRS, the actual guidelines from the IRS suggest and will recommend, they don't require, but that typically nonprofits spend about 65% of their expenses on programs, which is actually pretty accurate. Most nonprofits are overhead rates. True overhead rates are around 30%. All the research and studies that we've seen really put the 25 to 35% overhead rates is really the true overhead rates. And that's kind of what the IRS regulation, kind of recommendations. But you see a lot of groups out there, we spend 90 cents on every dollar on program. We spend 99 cents on every dollar on program, right? That's rarely true. It just means you're much better at allocating all those indirect costs to programs. You're just good at shifting the numbers around. No group can really survive on 99% going to programs. You need people, you need infrastructure, you need the systems, you need HR, you need IT, you need fundraising, you need a board, you need all of those pieces. And to be sustainable, that you just have to invest in those. And so starving the organization, saying, look how much we starve ourselves, is not always, I think, a very good indication of how effective and impactful a nonprofit's going to be. But this is something that a lot of the charity watchdogs and some other organizations, focus on. How much is going to programs versus how much is going to fundraising and operating expenses. And again, there's a whole bunch of, I think, similar ratios to that. There's something called program services ratio, which is pretty much the opposite of that. Instead of looking at how much you spend on fundraising and management, how much do you spend on programs? It's kind of the flip or the inverse of that. So if you spend 30% on management and fundraising, that means you're spending 70% on programs. And this is, you hear this all the time. We spend X amount on programs, and like it's some kind of badge of honor. But reality, what the heck does that have to do with anything? How much you spent on color toners and paper clips? What does that have anything to do with whether you're making an impact out there in the community? It has nothing. The numbers that really matter is what's your impact? How many people are you serving? How are their health and benefits being improved? How is life being improved? How are school, academics being improved? How are people getting jobs? How are people getting access to legal services? That's what matters, right? It's the people, it's the mission, right? It's not how much we spend on color toners and paper clips. That is not the indication. But some people think that's important. Nobody asks that when they go to Starbucks, right? How much does Starbucks spend on marketing and sales versus development programs? Do you know? Do you care? No. Who cares? You're like, this is good coffee. I like this coffee, right? This is a good program. I like this program. How much we spend, if I cure cancer, do you really care how much I spend on my fundraising? No, that's irrelevant. The outcome is what matters. But people get all hung up on these things. So just be aware of them. Same thing, personnel expense ratios. How much are we spending on people? I can tell you right off the bat, most of it's going to be 70%, 65, 75%. So it's not a very exciting ratio. But again, I mean, we're in the people business, right? And so most nonprofits, again, it's an indication how much are you spending on people as a percentage of your total cost. Fundraising efficiency ratios, I've seen some people argue that this shows basically, how much money we spend on fundraising versus how much money comes in from that fundraising. So if we spend $50,000 and we raise $100,000, right? That's our return on investment. But the reality is it's oftentimes very difficult. They're not one-on-one correlations like that. I mean, people give oftentimes because of the programs. They see the programs, they're seeing the you're doing, and that they may get a contribution that has nothing to do with your actual fundraising efforts, right? And then sometimes again, that blurring of that line between what's a fundraising, what's education, what's program, right? Those are very, very fuzzy lines. So you can try and make this a direct correlation, but again, you may have a fundraising team, but what about when the executive director or the program director goes out and gets a grant? Is that fundraising, or was that a program? Was that management in general? It's a ratio that makes it sound like every dollar that comes in is somehow specifically tied to a fundraising ask, and that's just not. It's not how groups work, right? I mean, we get money, it comes in. People say, hey, I saw what you did. I saw something on Twitter. I saw this. I ran into somebody. Here's a contribution. Okay. Should we include that or not include that? Right. So again, it's a way to kind of assess, how much we're spending on fundraising versus how much we're bringing in. And does that seem like we're getting a good return on that dollar? Again, you have to really understand some context in order to have that. So I think, again, it's there, but in general, I don't find that a very helpful ratio, unless you really have to do some really kind of forensic accounting around that. All right. So there's some common ratios. There's some in your reading, some in the book that you read, some of the things we read online. You may have other ones. So, the homework, our last set of homework here really is, out of the ratios you've reviewed, we've talked about, you read about, what do you find the most useful in terms of your day-to-day? If you were a manager, if you're a program director, an executive director, a board chair, what are the ratios that you think would be really important? And particularly, again, even from the donor's perspective or just other staff, like what are some ways that we can help tell our financial story using ratios? Which one of these did you like? Which ones do you not like? Which ones do you think, would be important to different board members, donors, or staff? So go ahead, drop it in the discussion forum. I'll be in there kind of helping out, seeing what folks talk about. The other kind of the discussion for this is the course feedback. What did you learn? Did you learn something new? Was there something that was surprising you had not learned when you came into this? Is there something you would change about this course? This is really, this is my first time teaching here at Antioch. I've done some guest lecturing, but really putting the whole course together. So if there's something where you think we can strengthen or improve it, please let us know, and we can make those edits and make the program even better next time. All right. And of course, we still are working on our final project. So again, go in, look at one of the nonprofits. There's 3 years of financial data in there in terms of audits. There's a financial analysis worksheet. Take that audit, enter the information into the worksheet. That'll do all the calculations for you. And then your job is to interpret that data, right? Interpret that. What is the organization trying to achieve? What problem are they trying to solve? Are they bringing in enough revenue to actually cover their operating expenses, and show the unrestricted revenue compared to operating expenses, and show me the unrestricted surplus or deficit, or the change in net assets, or change in unrestricted net assets, I should say, over the 3 years that you could do. And again, we're recommending using charts and graphs. The balance sheet, right? Again, we've talked about some of these different things. The key thing, I want you to calculate both months of cash and Luna for the 3 years that you're looking at the audits. But are there other things? Do you see a lot of liabilities? Do you want to do some of these ratios? Do they have enough assets to cover their liabilities, right? Is most of their assets frozen up in buildings and tables and chairs, or most of it's restricted? How much is unrestricted versus our total assets? These are some things that you want to be looking at to just, again, how much risk can the organization take, right? The operating dynamics is around, are we really bringing in enough revenue to cover our operating expenses, to cover our salaries and our light bills? Right? The balance sheet is, how much risk can we take? If we try something, or if there's an opportunity, do we have the resources to go ahead and pursue that opportunity? Or if something goes wrong, do we have a safety net that'll catch us if we fall? And then the overall assessment. What do you think? Is this organization doing well? Is it in trouble? Are there recommendations that you would make? Right? Would you donate to this? Would you invest in this organization? Give me your assessment. I want to hear your voice, right? No, don't just regurgitate numbers at me. Tell me what you're thinking. That's really what I'm looking for. And again, if you could use some charts and graphs or tables, that's helpful. I find it just much easier to read information in this way. So that's a tip or a suggestion. Again, you have your financial analysis worksheet. If you haven't sent it to me and you want to send it to me real quick, and have me review the numbers, because again, I don't want to have to be grading you on whether you can add two numbers together. This is not a math class, right? This is a graduate program here, and we are focused on your ability to interpret numbers. You're always going to have your CPAs, your accountants, all of those people do the numbers for you. They're going to pull the numbers. Your job is to take that and interpret that from a managerial perspective, whether something's good or bad. They're just going to tell you what's accurate. You need to put the assessment on that. And that's really what we're looking for. Well, I hope you all have enjoyed this program. I know I had a great time teaching it and getting to know everybody over these last 7 weeks. But as always, please feel free to reach out to me if you have any questions, concerns, or there's things you want to kind of check on before you submit your final project. But thank you. Have a great week and take care.